Hello and welcome back to the channel. So, if you're new here, I'm just reporting on my portfolio update. I do this, every time I make any changes or there's a major news update. So, if you want to follow along with the journey as I try to build a passive stream of income to gain some financial freedom in my life, feel free to hit the like button, subscribe, and share the video. So in Canada, the CPI actually declined for the third month in a row. So finally, some good news coming to Canadians. Last month it was like 7%. Now it's 6.9. So it's definitely getting better. And the stock market finally had 1 week where it finished in the green. So if you haven't looked at your portfolios this week, maybe you want to take a look. You might be surprised. All right, let's roll the intro. So in the last week has been very good for the portfolio. We're up 257.19 or up 2% just on Friday alone. Past week we're also up 2%. So again, great week for the markets. And then if we go to the all-time, we're only in the red by 6% or $1,100. So, this is going to quickly swing back up. Once the market decides, we want to buy stocks, we like stocks again, they're all going to go up. So this is the greatest time to keep buying stocks, compounding your dividends, just acquiring more shares of great companies at lower prices than we've had in a long time. So it's a great opportunity to be buying. They may go lower, but honestly, nobody knows where the market's going to head up or down at any short-term point in time. We only know that long-term, they're going to go up. So Apple is, holding on pretty well. It's been volatile, but it's still hanging on in the green. I did a little bit of buy in this when it dropped a little bit below my average, so just a couple dollars into Apple. Nothing too exciting here. With Algonquin, since the share price went down so much, I bought 3 more shares, going from 47 to 50. It's offering, almost a 7% yield, and it's mainly down just due to interest rates. So this is sector-wide, so all renewables companies are down. So if you don't have any exposure to those in your portfolio, could be an interesting time to add those to your portfolio. ATD's been hanging on very well. They're definitely not volatile like the rest of the market, and a position that's in the green. And they also announced recently that they're going to plan starting to sell cannabis in their Florida stores. So it's definitely a very interesting avenue for ATD, and it could lead to further sales growth if they roll this out to other locations. And the all-star of the portfolio is Aritzia. So I only have the 20 shares here, and we're up 37.6% because I bought this and then I identified an opportunity early. I sold out of other stocks to make it happen to get this position. So I'm very happy with how this has turned out. And they reported their earnings, which were fantastic, and I'll get into them right now. So in Aritzia's latest earnings report, their net revenue increased 50% to $525 million. Net income increased 16% to $46 million. And EBITDA went up 13.3%. So the company's heading in the right direction. Everything's going good here. So just key things to highlight here from the earnings report. Their USA revenue keeps growing at a crazy rate of 80%. So that's insane. It actually comprised like half their revenue. So half of the revenue is from the United States. And that's why this Canadian retailer is so interesting, is that they're making so much progress in the United States and growing at such a ridiculous rate that they're really taking off there. As you know, the United States has 10 times the population of Canada. You have a much larger market. So I think them focusing on growing in that much larger market and actually succeeding and growing their brand is going to lead to very good results for this company for many, many years to come. And the retail revenue increased 60%. E-commerce is improving to 33.3. So I do hear that, at least from the women in my life, that they really, really like the the website for Aritzia. It's very easy to use. You can deliver clothes to your home, or you can arrange a pickup at one of their stores. So fantastic, great. Gross profit margin decreased a little bit. It's not too nice to see as an investor. It could be alarming, but I do know that they remarked on this in their earnings calls that they're not going to increase the prices of their clothing because they're trying to build their brand. So I kind of like that approach, especially since they have such a healthy profit margin because they sell luxury items at a higher profit margin, that they're sacrificing the short term of making a little bit more money now for the long term gain of growing their brand, getting to more customers, and then those customers becoming repeat customers and just buying new clothes from Aritzia all the time. So I definitely like that they're more forward looking. They're not just looking for the short term. And another thing to highlight would be their inventory increased, so it's 150% higher. Now you may be thinking this is a terrible thing, like, oh, they're not selling their clothes, but that's actually not true. Last year, they actually had a lack of inventory, and that actually affected their numbers. So this year they're coming prepared. So this is to meet the sales targets of this year, and they're also doing this because the supply chain is unpredictable. So they're definitely just pulling forward, making sure that they can meet all their sales expectations going forward. And then for outlook, they actually increased outlook. So, while companies are saying, oh, we're not going to have a great time, it's going to be really rough, they're saying that the revenue is actually going to be higher than expected for the rest of this year. So instead of earning 1.8, 1.9 billion, they're saying, wow, we're going to do 2 or 2.05 billion. And they're doing more share buybacks. So they said that they purchased approximately 1.7 million shares at an average price of $38, which is actually around my average. So most companies don't do share buybacks correctly. So this is giving shareholder value because you're decreasing the quantity of the shares, you're increasing the value that each share holds of your company. So you have more ownership of the company. And my favorite thing is that they actually did the buyback correctly. They didn't buy the stock when it was overvalued or fairly valued. They bought when it was undervalued. Aside from that, Brookfield is taking a bit of a hit, so I'm pretty tempted to get more of this. I mean, there's a lot of stocks that I want to get more of, but everything's kind of dipped. So that's kind of the con of having a portfolio of individual stocks, is that you really have to compare every opportunity to each other and really pick what you think is the best going forward at that period in time, because the prices move all over the place. It changes what the best investment is all the time. So I definitely can say that if you're newer, maybe avoid those single stocks and just stick to ETFs. Maybe have one single stock as a small position and try to grow from there, because it's very difficult to manage something like this, and you have to keep a hold of all these companies, watch earnings reports, take a look at the financials, make sure that they're heading in the right direction. So again, BAM is only down because of interest rates, and people think it's going to affect their growth because they can't really borrow money and then reinvest it at high rates of return. But honestly, I think they can. They just may not grow as quickly. But they're a strong business, and one I definitely plan to hold for the long term, if not forever. Scotiabank, similar story. No issues with this stock at all. It's down, but the banking sector as a whole financials have really underperformed. So if you don't have any, or you're just starting out, definitely look into the Canadian banks. Costco's down a little bit, so it's been holding on fairly well. I would kind of want to buy a little bit more of this, just average into it as the price falls. If it falls a lot, I definitely want to buy a lot more Costco, because I really like this company. Very high quality, very dependable company, and I like its resilient, predictable revenue because the majority of it is just memberships. So they've already made all their money. They know what their income is going to be, and they make a very little profit on the actual products they sell to give their customers the best price. And if you keep your customers happy, well, why would they leave you? And I bought one more share of Enbridge. We went up to 71, so a little bit more passive income each and every month going into the portfolio. And I'm getting closer and closer to getting enough of these to start purchasing itself. So I need maybe like 30, 40, maybe 50 shares, and then this can start purchasing itself. And for H Yield, I got paid my dividend, and I reinvested that, and it dripped us 2 full shares. So we went from 187 to 189. So great thing to see there. I want to get all my stocks to the point where they can just purchase 1 share of themselves, and then that way it'll make the portfolio management a little bit easier. We're growing all of our ownership in these companies, and there's not too much thought behind it, especially when all the stocks are down. It's a great time to employ that strategy because everything is down. So you don't have to necessarily get the best value every time you're investing, but if everything's down, then you're probably getting a pretty great price if you picked a quality business in the first place, and if you think that you paid a fair price the initial time you bought it. Intel is one that's definitely hasn't not performed to my expectations, but I basically picked a cyclical industry, which is my mistake, at the top, the peak of it, during the pandemic when everybody was buying PCs. Now that's really slowed down. It's affected all the companies, not just Intel. So if you were in this sector at all, you got crushed. But long term, I still believe in my theory on why I bought the company. So we bought 1 more share, and it also released the best gaming desktop CPUs. So the 13th generation Raptor Lake is beating AMD, their main competitor. So for the bears out there on Intel saying this company's dead, well, they're making awfully compelling products, wouldn't you say? I mean, even though it's in a bad cycle and Intel is so far behind, how are they keeping up and beating AMD? Interesting, right? So definitely going to be holding this for many, many years to come because I'm mainly holding it for the chip making plants that they're building in the States and in Europe, and increasing their capacity and growing their and diversifying their business in that way. So that's why I'm not selling this one. And the earnings are in a week. So if you're planning to start a position in Intel, I'd probably wait for that just because the earnings might be bad. The outlook might be bad because we're not in a great cycle for semiconductors. So I'd say hold off for a week, just see the earnings. If it goes up, I can't imagine it goes up that much. But if it's bad, it could definitely drop further from here. And I'll be more than happy to purchase more, 1 share at a time here and there if it falls further, as long as my thesis on the company is intact and I still think it's going to achieve its target in 2025, 2026, which I do believe it will. So that's why I'm okay with the price being down. I'm totally comfortable because I know the inner workings of the company. I'm aware of the industry that it's in, and that really helps. So definitely know your holdings so you won't be scared and panic and sell them at a loss. And then Microsoft, I just did a little bit of a fractional buy. And I also purchased a little bit more TELUS. So we went from 30 to 31. So just love buying the dip on TELUS when I can. So it's a great company. It raises dividend all the time. And then Tesla also shared their earnings, and their revenue had a slight miss. But if you looked closely, their Giga Shanghai factory was closed for so long because of the very tight restrictions in China that are shutting down the entire economy. So they essentially missed on the top line revenue, but their earnings were higher than expected. Unfortunately for the stock, because Tesla is priced for perfection, if Tesla misses its goals or has a little bit of a hiccup, the stock is going to suffer. And who is the majority holder of Tesla? It's retail investors. So, normal people like you and me, not institutions like a bank or, a hedge fund. It's all retail. So if retail investors lose faith in this company, just like how this could be double the price that it is today, it could turn into half the price that it is today. So I think at the current price, if you assume a 50% growth rate over the next 5 years for Tesla and you think that it's going to hit it, then it'll give you a market beating return at the current price. But if it underperforms, then it could be very disappointing. So it all depends on your assumptions, right? And how conservative and how aggressive you want to be. I don't think you should be too aggressive. I think you need to be more realistic. I believe that the shares are worth anywhere between, let's say, like 160 to 220. That's a pretty wide range. I may average down on it, and we'll see how Tesla does in the future. But they also had a pretty cool update on the semi-truck that they're actually going to be delivering that to Pepsi in December. So it'll be finally time to see this in the market, and we'll see how that does for Tesla's bottom line, because electric trucks could be very, very lucrative. With the dividends earned, we've earned $839.67 since starting the portfolio. Annually, we're making $883.88. Monthly, we're making $73.66. So almost $1 increase from last time, just buying a couple more dividend-paying stocks. And in October, we've already surpassed what we make in September and August. We're also expecting another large dividend. We're going to be getting like $22 from Scotiabank on the 27th. So definitely looking forward to that. Weekly, we're making an extra 18 cents a week, so $17 per week. And daily, we're making an extra 2 cents a day. So we're back to the figures we were at before, when in my last update I kind of had a little bit of a drop because our Ethereum ETF was paying us a smaller amount of income than I expected. And the months to earn is back to where it was, and the hourly wage is unchanged at 42 cents per hour. If our portfolio were to go out there and work for me, a 40-hour work week, that is what it produces for me. So none of my labor is involved. It's all my portfolio doing it passively. That's why I love dividends. Once you set up your portfolio, you've picked your companies, it'll do the rest for you. Your companies are out there working for you and generating value for you. All right, so if you enjoyed the video, please leave a like, subscribe to the channel, share the video, and in the comments below, just let me know what stocks you're buying out there during this dip, or if you're not buying stocks, let me know why. All right, have a great day, everybody.